For much of the 1900s, Sears was one of the most important companies in the United States. It sold clothes, tools, appliances, and many other everyday items. For decades, millions of families shopped at Sears. The company felt stable and permanent. But over time, Sears slowly fell apart. This happened because of growing debt, major changes in retail, and a series of business decisions that weakened the company instead of fixing its problems. This is the story of how that happened. Sears at its peak. Sears began in the late 1800s as a mail-order business. People could order items from a catalog and have them shipped to their homes. This was very helpful when many people lived far from big cities. As the country grew, Sears grew with it. In the mid-1900s, Sears built large department stores in malls and shopping centers. These stores sold almost everything a family needed. Sears also owned strong brands like Craftsman tools, Kenmore appliances, and Die Hard batteries. These brands were trusted and widely known. By the 1970s and 1980s, Sears was one of the largest retailers in the country. Retail begins to change. In the 1990s and early 2000s, shopping habits started to change. Big box stores like Walmart and Target offered lower prices and simpler layouts. Specialty stores focused on one category, like electronics or home improvement, and did it better. At the same time, online shopping began to grow. Sears was slow to respond to these changes. Its stores stayed large and complex. Prices were often higher than competitors. The shopping experience became confusing and outdated. Instead of updating stores and systems, Sears continued operating the same way it had for years. The Kmart merger. In 2005, Sears merged with Kmart. Kmart had already been struggling for years and had gone through bankruptcy earlier. The merger created a new company called Sears Holdings. The idea was that combining the two companies would save money and improve performance. However, both companies had problems. They were losing customers, sales were falling, and many stores were old and underperforming. The merger did not fix these issues. Instead, it combined two weak businesses into one. Debt becomes a major problem. One of the biggest issues Sears faced was debt. Debt is money a company borrows and must pay back with interest. Sears took on more debt over time to cover losses and keep operating. As sales declined, Sears had less money to spend on improvements. More and more cash went toward paying interest on debt instead of upgrading stores, improving technology, or training workers. This created a cycle. Sales fell. Debt increased. Less money was available to fix problems. Sales fell even more. Over time, this cycle became very hard to stop. Stores were not updated. As competitors invested in better stores, Sears did not. Many Sears locations became rundown. Lighting was poor. Shelves were often empty. Floors, signs, and displays were not updated. Customers noticed the difference. Shopping at Sears felt worse than shopping at newer stores or online. Without investment, stores lost customers. With fewer customers, there was even less money to invest. Selling assets to survive. To raise cash, Sears began selling valuable assets. It sold real estate, meaning the land and buildings where stores were located. It also sold or licensed strong brands like Craftsman. Selling assets brought in short-term cash, but it weakened the company long-term. These assets had been important sources of value and income. Once assets were sold, they were gone. Sears had fewer tools to recover. Online retail takes over. As Sears struggled, online retailers grew rapidly. Companies like Amazon made shopping faster and easier. Customers could order from home and compare prices instantly. Sears did have an online store, but it lagged behind competitors. Its website and delivery systems were not as strong or as reliable. As more people moved to online shopping, Sears lost even more sales. Internal structure problems. Inside the company, Departments were divided and often competed against each other instead of working together. This made it harder to improve the overall shopping experience. Decisions took longer. Coordination was poor. While competitors focused on customers, Sears struggled to manage itself. Declining sales and store closures. Year after year, Sears reported losses. Sales dropped steadily. To cut costs, Sears closed more and more stores. Fewer stores meant fewer customers and less brand visibility. Store closures also made customers less confident in the company. People were less likely to buy appliances or warranties from a retailer that might disappear. Bankruptcy. In 2018, Sears filed for bankruptcy. Bankruptcy is a legal process that allows a company to reorganize its debts or shut down in an orderly way. By this point, Sears had too much debt, too many failing stores, and too little cash to continue operating normally. Some stores remained open after bankruptcy, but the company was much smaller than before. What went wrong? Sears collapsed because several problems happened at the same time. Retail changed, and Sears did not adapt fast enough. Debt kept growing while sales fell. Stores were not updated or improved. Valuable assets were sold to cover short-term needs. Online competition took customers away. Each problem made the others worse. The end of a retail giant. Sears was once a symbol of American shopping. For decades, it met the needs of millions of families. But businesses must change when the world changes. Sears did not adjust quickly enough, and debt made recovery harder every year. Over time, the company ran out of options. That is how Sears collapsed.